2023 marked the 10th consecutive year of my portfolio outperforming the S&P 500. Let's discuss how I landed on my portfolio mix and why it consistently outperforms the S&P 500 in both good and bad years. In this video, we'll quickly take a look at the past, we'll discuss the investing principles that I abide by, and we'll cover my specific strategies for investing in 2024. We'll also address the most common attacks against the way that I invest to help the bogleheads sleep at night. If you're new to the channel, welcome. My name's JFT&x, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy videos like this one, please beat up that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind throughout this video. Let's grow. Timeless principles. Any successful investor will learn to remain open-minded and to adapt over their investing career. I am constantly reassessing my holdings and taking in new ideas. Many aspects of the market and the proven strategies are ever-changing. However, some core investing principles will remain true forever. Let's cover my portfolio rules that apply to each and every year before jumping into my specific 2024 strategies. I have 3 hard rules with investing. Rule number 1, never use a financial advisor and avoid investing fees like the plague. Jack Bogle, the grandfather of index funds, nailed this one by often saying that time is a friend when returns are concerned and your enemy when it comes to costs. To show this, I'll use Mr. Bogle's example from his book, The Little Book of Common Sense Investing. In his scenario, he was investing $10,000 for 50 years, assuming a 7% growth rate. With 2% fees, you would end with $114,700. Without any fees, you would end with $294,600. Rule number 2, never invest in an ETF with an expense ratio of over 0.50%. And this goes hand in hand with the fees that we just talked about in rule number 1. Rule number 3, invest in passively managed ETFs only for long-term holdings. And a sub-rule number 3, hand-picking stocks with the proper research is better, in my opinion, than paying for actively managed ETFs or index funds. High-cost ETFs guarantee that you'll lose hundreds of thousands of dollars long-term, regardless of how the fund performs. I highly recommend that every investor out there reads The Little Book of Common Sense Investing by Jack Bogle. It is genuinely my favorite investing book by a mile, and I've read nearly all of them. It'll teach you the principles of how the market works and why the S&P 500 is so hard to beat over the years, which many other books will show that as well, but most importantly, it teaches us why the market works that way. John Bogle had years and years of working on his thesis and getting laughed out of the room in his early life before he ultimately created the first index fund. And it really is my favorite book of all time and one of my few rereads. And I'll leave a link down below if you want to buy a copy for the Kindle or a physical copy. It's time to quickly look back before moving forward. Past performance. I'm not a fan of overlooking my past mistakes and my past successes. Now, I never think it's healthy to dwell on past mistakes, but we can learn so much from our past to reduce the amount of poor decisions we make moving forward. In investing, my benchmark is the S&P 500, and if I can't beat it, I'll join it. Let's see how my long-term portfolio has compared to the S&P 500. And a quick note here, this isn't just showing off because it's performed well. I'll be showing this each and every year, win or lose, because it's a vital part of the process for future decision making. We're going to use Portfolio Visualizer for our backtest here. So we're pulling the last 10 years here from 14 through 23, and I put in these numbers to roughly mimic my portfolio. I'll explain that a little down below. It's just the starting amount of 100,000 and the contribution fixed amount per month of $28.75, and the frequency is monthly, rebalance annually, reinvest dividends, of course, yes, and display income, yes. So the objective here is to see if my current mix of 50% SCHD and 50% VGT is still worth holding compared to the market. Right now I hold a third of VU and a third of each of these, but I in a vacuum want to see if these holdings make sense to hold instead of the market. And this middle one is what I'm always thinking about and recommending to other people as well, because VGT is 100% tech and QQQ is fairly tech based, but it's only about 50% and it will self-adjust if the trends change in the future more than VGT, which will forever be 100% tech. So I love tech, but I always use this as my alternate situation of what I could be doing and what I may do in the future. I've always been this one right here, but it never hurts to check out the scenarios. So you can see 50% VGT and SCHD in portfolio 1, and then the same concept, SCHD and QQQ in portfolio 2. And really I would hold QQQM. M is in Matt. That has a lower expense ratio for the NASDAQ 100, but it doesn't have enough history to backtest yet. And then the market, of course, VU, 100%. This is what we're competing against. So I already hit analyze. Let's just do it again. And the reason I put in those numbers is this is roughly what my portfolio's at. And I had about 100K to start and I started cost averaging in. It's not perfect, of course, but to average it out, here's where I'm at with this setup. What is 1.25 million would have been 1.17 million, so not too far off if you use QQQ instead of VGT. And then the market would be worth almost $1 million with the same cost averaging in compared to the 1.25. Now I've made multiple videos, my blue bar, that's my setup. It beats the yellow bar, the market, each of the last 10 years. But as you can see, the QQQ mix won in these early years and it beat it last year. It's something I've been eyeballing over the years, and you can see it performs fairly strong over the years, just like VGT does. So actually, let's scroll down here. Annualized returns. This doesn't care when it was cost averaged in. This is just how the funds themselves performed. In the last 3 years, my mix is 11.8% total returns. The 3Q mix is 11.1%, and the market's actually randomly exactly 10.00%. Over the last 5 years, you can see it's been ridiculous. The VGT mix is slightly outperformed. The QQQ mix at 20.3 to 19.2. And over the last 10 years, which happens to also be the full amount of time for this testing, we have 15.8% versus 14.9 for the triple Q and right around 12% for the market. Historically speaking, the VGT mix is better, but that doesn't mean it's going to be the best in the future. I still currently believe in tech, and we'll get into that in the next section. Any of these three holdings are great. I just like to assess, does it still make sense to have this combination compared to only carrying VU for many years into the future? And the only thing we have to do today is ask ourselves that question for 2024. All right, that's enough of the past. It's time to move into the future. Investing in 2024. This is likely going to be a bit of a sad year for my portfolio. And that's not because I've lost faith in my strategy. It's because I don't have the money to dollar cost average into my allocations like I normally do. I left my 6-figure job in the dust as of July 2023. But I do have a nice portfolio to build on. Let's discuss the battle plan one position at a time. So the first thing I'll do is talk about VGT and SCHD. I like these to be about equal within my portfolio. And ideally, I like these three holdings, so throwing VU in there as well, to be equal. So as you can see here, VGT has begun to run away a little bit, and it's been doing that over the last year and change. I rebalance quarterly, so I'll work on keeping SCHD and VGT equal to each other. As of right now, I don't have any planned contributions to VGT and SCHD for 2024 because of my lack of income, except for I will very likely max my Roth IRA contribution. And so I'll put the $7,000 into right now what would be SCHD to ultimately try to keep these close to each other. And then there'll be some rebalancing activity quarterly as well. So a total of $7,000 will go into these two positions. VU, which is actually technically a different index fund from Boeing, my wife's 401k, will be cost averaged into each paycheck, including a company match. So naturally, this one will very likely past these two until I have income to throw in the future. The long-term goal is still to keep these equal. It won't be perfect right now with the imbalance of contributions, but nothing has changed from a high-level strategy in the sense that I want these three holdings to be about the same, a third each of my long-term portfolio. Cash, I would like to keep at around 10% in any market. So if the market takes a dive, all of a sudden I'd be cash heavy. Say my total value is 900K and I'm sitting on 138,000 in cash, I would deploy this cash into the mix to get it back to 10%. And when I fund that Roth IRA, that'll chunk 7K out of here and get it closer, and then I'll slowly balance it throughout the year. JEPQ, I don't plan to add to or remove from. I'm loving the cash flow from it. I consider it cash. I consider it greedy cash, basically. So the shares I have will sit here and I'll take the dividends I get from it and distribute it into my portfolio or to my checking account to pay the bills right now. So JEPQ isn't a taxable account. I understand the tax implications, but my wife and I are actively using that money for living expenses at the moment. Crypto, I gotta say, is gonna be a whole nother video. I'm making major changes here, I think, in the near future, and I'll get into the details of that very shortly. I think it's going to move up the priority list of video releases. But I will say the overall amount of crypto in my portfolio, I plan to keep around 2 to 3% long term. So this isn't going to change, but where I hold it and how I hold it is. And a lot more explaining needs to be done with that one. This one's just our HSA account. It'll be cost average into the full 8,300 this year. And this is my wife's from work. She gets a $1,250, so we make up the rest as our contributions to get to 8,300 by the end of the year, and it'll go into what is basically VUG. That's the best holding in that one. And then my stocks, these are individual stocks. They're very low amount. That's the HODL factory that I explained in my last video. If you didn't see that, I'll leave a link in the description below. These are my best friend and I hand picking stocks, and I plan to long term have this be somewhere around 8%. I want my individual stocks and my crypto to combine for 10% of my overall allocation. So I'm way behind, and I'll inevitably be a little behind. 2024 might not change that a ton because of the lack of income. So really, I don't have any core changes in my portfolio and my strategy in 2024 compared to 2023. It's time to check out our planned contributions for 2024. And these numbers could change drastically if there is an uptick in revenue on my end. My wife and I plan to put $3,662 per month into the market by default this year. And that is coming from, in fact, I think I have it here. Let me scroll lock over. I do. So $2,970 is monthly contributions to a 401k, including company match. The math is all in here. $692 a month is from her HSA, and that includes Boeing's portion as well. It gets it to a total of $8,300. So that's the initial amount we're putting in. I'm also planning on funding my Roth IRA for $7,000 and could be trickling more money into the market if I begin to make money this year. But this is the default plan if I don't. And this is our current investment. This is a spreadsheet, everything's feeding through. These are all direct formulas. So our current investments as of last Friday, I update this weekly, are here. If you put this in per month, and I'm forever an optimist, so you can't take that out of me. I'm using 10%, get off me with that 7%. I know how you're supposed to project. I did it for a living as a financial analyst, but I want my 10%, baby. So this is just my age, end and balance, so that you can see here's our current balance after 1 year. When I'm a year older, goes to here, and so on and so forth. This is with these contributions up here. And this is just a projection, of course. Obviously, it's subject to change. Now, if you guys twist my arm and you force me to use 7%, boo. Now, the numbers are still decent. It takes a while to ramp up at this point. The difference in just every percent of compound is amazing. When you take it down 3, it drops it quite a bit. I usually like to look at when I'm 55 years old. 4.3 million, so I think that's doable. And I hope to have lots of one-off contributions, but when I make tools like this, I like to just look. Oh, and you guys can't see that, I'm sorry. 55 right here, I forget how zoomed in I am. But when I make tools like this, I like to just use Conservative estimates, so we for sure are putting this in by default without doing anything. And this is just the current amount, could go up or down. We're looking at exactly what this is, and we're looking at the baseline monthly contribution. So, I could put 10,000 in here, but that wouldn't make sense. So I like to keep these as realistic as possible. The common attacks against my portfolio. A few people have mentioned that I'm performance chasing with my portfolio. Am I performance chasing? Kinda. I mean, I don't see performing well as a bad thing, but I understand how performance chasing is used, and no, I'm not performance chasing. And these people will go as far as to say, if you're going to be chasing performance like this, you might as well put 100% into Tesla or go all in on Bitcoin. I know my portfolio isn't fully risk-free, but that is quite the leap. After all, I do have 100% of my long-term investments in low-cost, passively managed ETFs. VGT is where I started initially because I love tech and it performed well. That is why I also roll with SCHD as a nice counterbalance to VGT, along with a big chunk of the market itself, VU. SCHD and VGT only hold 3 of the same companies, and that's out of 100 and over 300 companies respectively. Really, SCHD almost replaced like the traditional bonds in a portfolio. It's my floor raiser for the bad tech years. There is some risk in my portfolio, and that's why I rebalance quarterly and I assess potential core changes on a yearly basis. The biggest risk I see is that if tech takes a long-term nosedive. With VGT being 100% tech, that wouldn't be good. And this is why I have an easier time recommending QQQM, the NASDAQ 100 holdings, to most investors. And I've even considered it for years now of making it my growth or part of my growth ETF section as well. Another common complaint is that I'm too heavily exposed in Apple and Microsoft. My short answer to that is no. My long answer to that is let's take a look at my spreadsheet. I threw together a quick little spreadsheet here that isn't going to win any beauty awards. It just shows the value that I have of each of the 3 primary long-term holdings that I roll with, VGT, VU, and SCHD, and you can see they're all about a third, or at least they're supposed to be. VGT is currently constructed of 21.5% of Apple and almost 20% of Microsoft. VU is 7% of Apple and almost 7% of Microsoft, and then SCHD has 0% of both. So if you take a sum product and get my total ownership of Apple, of these 3 holdings, overall, I'm weighted at 9.6% of Apple and I'm weighted at 9% of Microsoft. So it's a lot, but it's not what it looks like when you just look at VGT and VU. That's the beauty of SCHD coming in to help counterbalance. And having a lot of these 2 companies hasn't been a bad thing, you guys. Let's jump over and check it out. I've pulled up a total return chart for VU, Apple, and Microsoft. And yes, I know this is past information, but this is one of the reasons that the market cap weighted VGT has severely outperformed the market over the last 1, 3, 5, and 10 years. So over the last year, you can see that the market is up 24.5% to Apple's 35 and Microsoft's 70. Over the last 3 years, the market's 36 to Apple's 45 to Microsoft's 75. Zoom it out 5 years, you have 100% for the market, 374 for Apple, and 304 for Microsoft. And over the last 10 years, Apple and Microsoft up over 1,000%, and the market's up almost 230%. Again, yes, past performance, but holding these 2 stocks has not been a bad thing. And when it's not, VU and VGT will both scale down. And now you may be waving your performance chasing 101 flag on me. But I'm worth $200,000 to $300,000 more than I should be worth because of those 2 companies. And if they fall out of favor, I will automatically be less exposed to them because VGT and VU are both weighted on market cap. In other words, it works the same way as the 20 or so companies each year that fall out of the S&P 500 completely. And the last one I get questioned on is why not just completely scrap SCHD and roll 100% with VGT, because it's absolutely smashed the returns of SCHD and VU over the last 10 plus years. If my life was a video game where I wanted to become as rich as possible without caring about the potential consequences of losing the vast majority of my money, this is exactly what I would do. But my goal in reality here on Earth is to build steady wealth by outperforming the market on a yearly basis. I figure if I can continue to beat the thing that most of the brilliant investors recommend rolling with, then I'll be looking pretty good in 20 years from now. Check out this video right here if you want to see the full details of my portfolio as of January 2024. And if that doesn't tickle your fancy, check out this video over here. Thank you so much for watching, and I will see you here each and every Thursday, and usually on Sunday. Bye.